Welcome back to another Meet Kevin report. Today is February 9th. It is a Thursday, and we are on Meet Kevin report number 18. Thank you so much for joining again. Okay, lots to talk about today. Consumers, inflation, what the heck is happening in the world politically, what's going on. First of all, a few condolences. First of all, Senator John Fetterman is Democrat. He is in the hospital, potentially. There's some rumors that he may have had another stroke. He's previously recovered from a stroke, and now he's in the hospital again. So obviously, best wishes to a speedy recovery there. Doesn't matter if you're a Republican or Democrat. Nobody deserves to go through health issues. Unfortunately, many of us do, and there are many of us who are unfortunate and suffer from ailments people don't deserve to. So I really wish the best for everyone, and knock on wood that everybody can recover healthily from any of the issues they have. Unfortunately, then you have to look at Turkey and Syria. You've got nearly 14,000 dead now thanks to the earthquakes, which is absolutely terrible. And I think what's additionally devastating, I can't say more devastating because any loss of life is already devastating. It always hurts me, is that right now we are entering the phase, as you're listening to this, we are entering the phase where some people who are actually alive under the rubble of collapsed apartment buildings and homes were sitting at their breakfast tables or their dining tables, their couches, their beds, working in their offices, maybe on their laptops, just like we might be right now, are suffering without food or water now for coming on over 48 hours. And unfortunately, that is not good. There is time is against everyone under the rubble right now, and getting emergency support and aid to those in Turkey is not easy, especially since Turkey's been suffering from massive governmental upheaval over insane levels of inflation. I mean, we're talking 80 to 90% inflation, down to a low of 69%. You actually had Twitter that was banned in Turkey, but the ban being lifted just yesterday as folks see Twitter potentially as a communicating tool for this emergency, which is terrible. A, that it was banned in the first place, and obviously B, the earthquake issues are so devastating. But it's something to remember is a lot of people make fun of the building requirements that exist, for example, here in California. And I know a lot of people that come from Florida or from Europe, and they're like, and I'm talking more like Western parts of Europe, and they're like, Kevin, why your homes are built out of wood out here? That's insane. That seems so cheap. We build homes out of cinder block and brick. And I'm like, yeah, well, you deal with hurricanes and there's always this belief that, California builds homes cheap. And one of the things that I've learned in construction is that one of the beautiful things about wood is that it is flexible and it can move. But the amount of building standards that go into earthquake retrofitting in new construction today versus old construction is ridiculous. And this is by no means to say that Turkey made any kind of mistakes. We have old homes here in California as well in earthquake zones that are not earthquake retrofitted. I mean, we have homes that sit on foundations that are basically just stacked blocks, and a home could easily fall off of those foundations in an earthquake. But you look at some of the new construction that's built now and what goes into earthquake support for these structures is incredible, and you just don't have that in old buildings, let alone in Turkey. And so these things, they just collapse, and it's so terrible. So it's pretty devastating. So I wanted to start with that today. Moving on, and sort of on the note of Twitter, apparently Twitter has around 290,000 subscribers for Twitter Blue worldwide now. This is from The Informer. 62% of those are in the United States, so about every 6 in 10. It is worth noting that Twitter Blue just released the option for you to tweet a long tweet rather than these 140 character limited tweets. Now, this I've actually really enjoyed. You should follow me at RealMeetKevin on Twitter. And the first long tweet that I sent, I would love to share with you here. It is the following. Finally, long tweets. Threads suck. And it's true. Threads are like terrible, absolutely terrible. You try to read the Twitter files and you go through the threads, you get confused in terms of wait, you're on number 13. Where'd number 14 go? And you click over there, oh, there's 14. Oh, but wait, why is 17? It is a disaster. So finally, long tweets are here. So I've been, this is my first long tweet here. So it just repeats flip-flopper over and over again. I'm doing sort of the what's it called? You gotta have your punishment, right? So you have to write on the board 27 times what you did wrong. I actually, I don't blame myself for being a flip-flopper. I think I'll always be a flip-flopper. But the nice thing is, anytime I flip-flop, you can see that transformation here, and you could watch me flip-flop, and it costs you zero. You just press the little subscribe button, and you could watch me flip-flop. In fact, if you want to get notifications for my flip-flop, you could download the totally free Meet Kevin app in the Apple or Android App Store. By the way, we are working on an update for that app, so that way you could choose what notifications do you want: normal videos, live stream videos, or short content. So I think that'll be really cool. So stay tuned for that. Activision Blizzard just had the United Kingdom's antitrust regulators come out and suggest that the $75 billion Activision Blizzard acquisition by Microsoft would end up hurting gamers in the United Kingdom, dealing another blow to Activision. This was actually a play that for a while Warren Buffett was playing as an arbitrage bet, although it seems that recently he's been reducing his position and exposure to this thanks to the regulatory concerns. Keep in mind that the FTC in November sued Activision Blizzard and Microsoft to block the deal. Yikes. Canada Solar potentially poised, or Canadian Solar, I should say, poised to grow faster than peers in 2023, with potentially sales exceeding expectations. The solar industry has been pretty dang resilient, although we'll see if we end up seeing any kind of softness going into the rest of 2023 as the housing market potentially starts showing some red flags. We'll talk a little bit about Enphase and their earnings a little bit later in this video. China is cutting rates again for homes. And one of the crazy things that's happening in China, and we won't go super deep on this, but I want to just sort of give this little indicator here. One of the things that I'm noticing happening in China is people are very skeptical to spend again. Now, don't get me wrong, they're spending on travel and entertainment, but they're very skeptical to spend on goods and real estate. And that's very interesting because real estate is the bulk of the Chinese economy. And consumerism is only about 32% of the Chinese economy, although that's expected to substantially rise this year, given the real estate slowdown. But boy, you're in this really weird situation in China where I personally believe, and I think the Chinese are pretty smart for this. I think the Chinese realized when the lockdown started, they're going to have to save their own money. They're not going to get helicopter money like we did in America. And they did so very well. But in addition to that, they don't necessarily trust the idea that you should just go out there and jolly lolly spend everything. And if something bad happens, the government's going to come bail you out again. Because A, the government didn't in China, and B, the government probably won't. So pretty incredible because there are obviously a lot of fears that China's reopening is going to lead to this surge of inflation. But so far, I don't know, it doesn't seem like that reopening is materializing as well as it potentially should. So wild. Yeah, we'll talk about that Enphase best earnings report ever, Kyle. It actually wasn't the best earnings report ever, but stay tuned. I'll show you exactly why. I know why headline it might seem that way. So you're not wrong to say that some of the headline numbers were the strongest ever. Yeah. I don't know that you could blame cheap construction. I don't think you could do that. I think you have to remember that really, even in the United States, before the Northridge earthquake, just 30 years or so ago, the earthquake standards here were not that great. Any home built in the 1920s, 30s, 40s, 50s, 60s, the earthquake standards are not very strong. So this is not a matter of cheap construction. In fact, people say homes were built expensively in the 1950s. They used redwood, after all, which is termite resistant. It's not a matter of cheap construction. It's a matter of the minimum building standards were just not elevated to the levels that we have today until, quite frankly, I would say the last 25 years. I live in a 2008 home. And I feel very grateful that I live in a 2008 home. It has fire sprinklers. It's extremely earthquake retro, well, not retrofit. It was built to a very high earthquake standard. And that's not to say I want to be in an earthquake, but let's just say I feel much more comfortable in this than what I used to live in, which didn't have insulation in the walls, didn't have fire sprinklers, my first home, and didn't have retrofitting for earthquakes. So oh, you lived through earthquake. Ouch, says Armando here. Yeah. But yeah, Mustafa, I can't say that it's cheap construction. I think it's just old construction, and I think when we look at today's building standards versus the old stuff, it's like, wow, that's how you guys did it back then. It was bad. It was really, really bad. So, all right, now we've got to talk about this, and I think we're not going to spend a lot of time on this. This is going to be very brief, but I find this very interesting, and I'm mostly opening this up because I'm very curious to see what your commentary is on this later. So stand by for 1 second. Okay. All right. Oops. So Piers Morgan had a piece on his show talking about a child grooming. This is basically where sex is taught to children under 9 years old. And I just want to know what you think about the blonde lady's response, okay? Wait for the blonde lady's response. And keep in mind, I have a 7-year-old and 5-year-old, and they don't need to know about sex ed at this age, okay? But I just want to hear what you think about the blonde girl's response, because in my opinion, it's mind-blowing as a parent that somebody would say that. But let's listen in here for a moment.
About being proud to be gay.
No,
it's about being proud to be you.
You can teach tolerance and understanding, but not at 4, 5, 6, 7, 8.
I don't hear
we actually do that. Aside
tolerant.
from all of this, we actually teach sex quite explicitly in heterosexual relationships from a really young age. You actually have children in nativity plays where you're playing a mother who has an immaculate conception and then gives birth to a baby. What are you teaching about? You're talking about
if you've ever, as I have done.
You got to be kidding me. Her argument is that, teaching sex to young children is already normalized because kids play house. What kind of crazy, cracked up argument is that? Sorry, I had to get that out of the way. It was just like, I saw that and I basically vomited. I'm like, my kids playing house is not them learning about sex. It's them playing house. Okay, mommies have babies. That's what they do. That doesn't mean they're now fully sexually groomed. Oh. Sorry. So some of the things that we're going to touch on, I just get somewhat angry about, and I'm sorry. I have to do it. All right. Anyway, now, here's another thing I could get angry about, because that's just the way it works, I guess. Okay. So look. Okay. So homelessness. Homelessness is such a disaster in California, and the California government is such an abject failure that you will not believe what LA County is spending on homelessness in 2023. And you won't believe how many homeless there are receiving that number. Now, it is absolutely ridiculous. Before I tell you how ridiculous that number is, I want you to consider for a moment my insane, as I was called insane, and I was called, like a militiaman. I was called crazy things about locking people up or whatever, which is just insane, by the way. But I was called crazy things when I ran for governor in 2020, because I had what I thought was an incredible plan for solving homelessness. Imagine my plan quickly for a moment, okay? First of all, how about this? Emergency and immediate support for mental health. How about starting there? How about actually making it so that a homeless person who wants to talk to a doctor doesn't have to go in a 6-month queue? And how are they going to get through the general care process and then get to a mental health professional in Los Angeles? They don't. It's impossible because A, you're not even capable of getting yourself there because you don't have any money. And B, even if you did, you have to wait 6 months. And by then, who knows how many drugs you've taken? It's absolutely disgusting. Living on the streets in California is extremely dangerous. You are substantially more likely to die living on the street than if you're not living on the street. That should be obvious. But let me put it this way. You've probably got a murder or death rate amongst the homeless population around 15 to 20%. When you walk through your daily life, you don't walk around thinking, I've got a 15 or 20% chance of dying today. Okay, that's what the homeless population has to deal with. Now, don't get me wrong. There are a lot of issues that lead to homelessness that need to be solved. We need more housing in California. We need eviction support services that are much more robust and capable rather than villainizing landlords. We have to recognize that a lot of the population in California, thanks to the terrible California school systems, which rank 40th out of 50, that's bottom 20%, by the way, in the United States, maybe people are just undereducated and just don't have the opportunity to actually get out of a state of economic despair. So when you start putting the pieces of the puzzle together, you realize when I ran for governor in California, I ran under the premise that, we need to solve the causes of homelessness, right? We've got to solve the education disparity. We've got to solve the economic gap. We've got to solve the lack of housing. And these are all things that can be solved. We can build more homes very quickly. We just need a governor that will actually lead the charge, not the kind of governor that we have now, who says things like, hey, we want people to be able to build more accessory dwelling units, and we're going to mandate that cities approve permits within 60 days so that homeowners can turn their garages into accessory dwelling units. Governor says that. Guess what actually happens at the city level? City says, yeah, we'll review your paperwork for 2 years, and we might deny you because you might be in a fire zone. Oh, wait, all of California is in a fire zone. Guess we ain't doing ADUs. Whoops. And what does the governor do? Nothing. Because he got to go to the Google campus and talk about how great it was that they were passing SB 7 and all these bills that suggest, housing's going to be so much easier in California. And what practically happens? God awful nothing. Because the government of California is an abject failure. And it's not because the people, it's not because of the bureaucrats, it's because of the leaders. The leaders don't have any balls, because the people who try to run for governor in California, the exception of me, because I wasn't born in America and I can't do it, usually they try to end up setting themselves up to run for president. So they set themselves up to run for president by basically coasting through the governorship in California, not rocking the boat like Mr. Gavin Newsom, so they could end up running for president. And then guess what happens in the meantime? All the judges want to be your buddy in California, because if you do end up becoming president, those California judges want federal appointments, or maybe they could even get to the Supreme Court. So the system is highly, highly broken. And look, I'm not Mr. Tinfoil Hat. I think many of you know that. I'm so aggressively in the middle. And, I consider myself a JFK-style Democrat, although even saying that these days pisses people off. I like to say I'm 51-49, okay? That's what I like to say. Republican, Democrat, Republican, whatever, in the middle. Now, what is really incredible about that is listen to sort of my idea here or on homelessness, and then listen to what's actually happening, okay? So in addition to solving for housing, mental health, and obviously support services like being able to provide medical care for people, and also fixing our school system by actually teaching people trades or white-collar professions so they can graduate high school being capable of functioning in our economy rather than floundering, debating, do I want tens of thousands of dollars of student debt, or do I actually want to start working at 18, right? That should not be a question. You should have the skills you need at 18 to get a job that you could live off of. You should be able to build a career at 18. That's what we were going to build. But anyway, I didn't become governor. Got almost 1 million votes, though, and came second place for the recall candidates. But anyway, my plan for homelessness was very, very simple. In the areas that we have homelessness, what's crazy about this is some people are like, wait, you can't do that in our areas. And I'm like, dude, you have all the homelessness already. But anyway, in the areas where the homelessness problems exist, we create emergency facilities that provide everything you need: a bed, food, medical care, like triage style medical care. Obviously, I mean, if we could have on-site mental health, great as well. Provide all the services that you need if you fall into the level of despair that you have to sleep on the floor. But guess what? There's only one, there are two big rules. Rule number one is you can leave anytime you want. These are not like handcuff facilities. These are not places that you have to go to. And then, of course, people respond and go, well, why would you go there then? It's simple. Because their second big rule, and this is really what I call the number one big rule, is nobody sleeps on our streets in California. Because when people sleep on our streets, they dramatically increase the likelihood of dying. They make other Americans and Californians feel unsafe. They hurt tourism, they hurt our economy, and they hurt the mental health of the individuals who are sleeping on the street. And they increase the drug problem that we have on our streets, and they increase the mental health problem. There is no good that comes out of sleeping on the streets in California. So my plan says, look, you don't have to go check in, but every time you fall asleep on the street, you're going to just happen to respawn at one of our facilities. And that means either you come with us or you start walking on your way, or we take you there. It's very simple. And hey, we can take you there, have a bagel, brush your teeth, take a shower, pop on some, donated clothes or whatever. And if you want to go walk all night long, fine. But if you fall asleep, you're going right back. And it would be challenging. Don't get me wrong. The first few months of this would be difficult. And we would do it with the National Guard for the first few months. But guess what? I promise you, within 6 months, there would not be a single person in California sleeping on the street or dying on the streets anymore due to homelessness. Because people will realize, damn, if I could go here and have a bed and have food and a shower and clothes, why would I sleep on the floor? Especially if they're just going to bother the crap out of me and pick me up and keep throwing me in here. And they can get up and leave all the time they want. And the idea then is, what have you done? You've centralized the homelessness problem. Now you start solving why people are falling into homelessness. You solve mental health, you solve the housing, you solve the education. That's going to take a long time. But at least immediately now you've concentrated where everybody is. And guess what? Oh, hey, good to see you again, Robert. Hey, by the way, so-and-so's coming in today. They've got job opportunities paying $17 an hour. If you're interested, they'll be here at 10. And guess what? You actually can now centralize the support services to try to reintegrate people in the economy. And don't get me wrong, not everybody's going to look at that and go, yeah, okay, I'll work. Not everybody's going to want to do that. There are going to be some people that might never leave sort of the trap of homelessness. But listen instead to what California is doing. As of September in 2022, the latest homelessness count for LA County is 69,144. California has accounted for 30% of the country's homeless population, despite making up less than 12% of the entire country's population. That is obviously in part because California has, well, at least Southern California has some of the best weather in the world. The weather that the Southern California coastline has only exists in 7% of the world's land. That's it, okay? And it is the only place in the United States that has the weather system that we do, which is the Mediterranean chaparral climate. Basically, nearly, I'd say 80 to 90% of the time, you're looking at 72 degrees year-round, no clouds. It's insane. It's beautiful. But what is LA County doing? Oh, LA County has about 69,000 homeless folks, and they're spending a record $609 million on homelessness this year. That amounts to almost $10,000 being spent per homeless person. And guess what? When you drive around LA, what do you have? Homeless on the streets, homeless dying on the streets, homeless in tents at the side of highways, all over the place. People getting accosted, people dying, the drug problem getting worse, the mental health issue getting worse. Everything is a complete disaster. And at the same time as homelessness is increasing in California, like downtown San Diego just hit a record for 6 months in a row of more homelessness. What are other states doing? Oh, wow. States like Florida are actually managing to decrease their homeless population because imagine this. They're actually funding emergency shelter, supportive housing, job training, and mental health treatment. Holy smokes. What I ran on 2 years ago. Actually, it's almost slightly more than 2 years ago now, which is crazy already to think about. But more than 2 years ago, that's what I ran on. That's insane. It's absolutely insane that California can't figure it out. The richest state by GDP in the country and can't figure it out. Potentially let's see, Turkey and Germany just boosted up. So we're probably around the 7th largest economy in the world, 6th or 7th, somewhere around there, depending on how you count India and Germany in there. But anyway, sad, really sad. That's my take. Had to get it out of the way. I'm sorry. Some people are like, Kevin, that sounds too aggressive. You know what? What we're doing now is aggressively stupid. And I don't know if it's because you got a Democrat problem or it's because you've got a Republican counter problem. I don't think that's the problem because let me make it very simple. California happens to be a supermajority of Democrats. Now, I'm not trying to offend people who are Democrats. I'm just saying California happens to have all the power literally in one party. This is a one-party state. And I'm not saying that California is like Joe Biden has the presidency and the House and the Senate. It's a little different in our legislature. So we have the governor, who's a Democrat. We've got the assembly, and we've got the House in California. And guess what? When you put it all, or the Senate in California, when you put it all to the assembly, sort of like the House version, you've got the assembly, the Senate, and the governorship, all of them Democrats. And guess what? They have not a 50-50 majority. They have a super majority in every chamber. So governor's obviously Democrat. Each congressional house, well, legislative house, we call it here, super majority of Dems. In other words, if there was any even potential of a Republican governor coming in, the legislature could just veto anything the Republican governor does. Anything. Because they have a supermajority of control. And some people are like, oh, but Kevin, back in the day, Arnold Schwarzenegger, he was a Republican. Yeah. Didn't have a supermajority of Democrats in the legislature then. Yeah. Crazy. Crazy. That's all I got to say. All I got to say. And it drives me nuts. All right. Next. So let's see here. Armando, you're making too much sense. Thanks. I am definitely not going to run for something in 2024. Definitely not. I am going to run house hack. Oh, man. I don't know that people just don't care. I think you don't have leadership with balls in California. I think it's simple. Of course, nothing actually in practice is simple. Everything takes hard work, but you need people willing to do that. And if you don't have people willing to try, then you may as well just roll over and die. It's stupid. All right. What is next? Next up, we got to talk about Tesla. All right. Stand by. We'll talk about Tesla in just a moment. Let's check in on Bloomberg for just a moment.
How do these guys respond when we disinvert? Someday we're not going to have curve inversion, and I wonder what the world's going to look like.
I'm fascinated also, Tom, just the process of price discovery in private markets over the next year.
Well, and a lot of people saying, if you don't discover the price, maybe it didn't happen.
Just like that. That's very philosophical, that is.
I've heard that before.
Nice, Lisa. That's
Thanks,
nice promo.
thanks.
Okay. That's, sometimes I click over to Bloomberg and they're just talking the biggest nonsense ever. I think they just get bored in the mornings and they have no idea what to talk about. It's ridiculous. Bloomberg. I don't know. I who knows? All right. We need to talk about Tesla. Tesla. Wow, Tesla blew it out of the park with manufactured vehicles in China. 66,051 manufactured vehicles in China, up 18.4% from December. BYD still beat Tesla, though, shipping 150,164 vehicles. But remember, BYD ships a vehicle that is about half as expensive, and only about half of their vehicles are actually fully electric. You've got a lot of hybrids in there and still a lot of traditional ICE vehicles. The overall passenger vehicle market in China is sitting at about 1.24 million cars produced. Production is expected to ramp back up in China as about 80%, according to The Economist, of Chinese have been exposed to or have caught COVID, and folks are expecting to be well back to work. The current targets for production at Giga Shanghai at Tesla are somewhere around 20,000 units a week, starting in late February or March. Li Auto, Xpeng Motors, and NIO all had monthly and year-over-year declines in sales, and that might be because Tesla's price cuts are putting substantially heavy pressure on other manufacturers which are not profitable or are barely profitable. Now, I got a lot of heat when I started talking about this on TikTok. On TikTok, I made a video talking about how Rivian, from a gross profit point of view, it costs Rivian $271 to generate $100 of revenue. That's disgusting from a gross profit point of view. That basically means you've got about $1,500 being spent to make somewhere around like $580, rough math, okay? It's insane how much money they spent just on a gross profit point of view. Don't even look at net income because Rivian's losing money like crazy. Tesla, on the other hand, right now, when they bring in $100 of revenues, looking at somewhere around $20 of $20 to $25 of gross margin, and maybe around 15 to 17% of net. And that depends on how conservative you want to be on the estimates, right? Technically, in the last quarter, we were closer to a gross margin of 25%. But we've gotten some heads up warnings that we expect that to compress a little bit. But the point is, Tesla is wildly profitable, while other companies are not. BYD bringing down about $1.40 to the bottom line in their earnings relative to Tesla, as we've said, somewhere around 17 to 20 bucks. It's insane. Now, I got in a little bit of heat on TikTok for Rivian because people are like, oh, well, when Rivian was small and just doing 7,000 vehicles, or when Tesla was small, just doing 7,000 vehicles, they were losing money too. And then what I did is I went back to the 2014 numbers, which roughly aligned. Tesla sold and manufactured around 7,300 vehicles, and Rivian did about 7,600, 7,700 in the last quarter. So when you align that, you're like, okay, they're roughly a similar manufacturing stage. Well, we already know that Rivian's gross profit margin is an abject failure. You're looking again at spending $271 per $100 of revenue gross. I'm not talking OpEx here. I'm not talking about advertising or SG, selling and general administrative expenses or research and development. I'm not talking about your OpEx. I'm talking about gross profit, abject failure, gross profit. Well, if you look at Tesla back in 2014, when they were manufacturing just as many vehicles as Rivian was, guess what their gross profit was then? Remember, Rivian right now, negative $271 per $100. Tesla per $100, still bringing $20 to the bottom line. In 2014, so I made a follow-up TikTok talking about that. And guess what the morons in the comments said then? Oh, sure. Pick the quarter where that makes sense. And I'm like, you moron. I picked the quarter where the production aligned relative to the most recent quarter for Rivian. It's like some of these people have their heads so far up their own behinds. I think they're just blind bag holders who don't understand the basic premises of fundamental analysis. People don't get it. Look, if you are an investor, you should so crystal clearly be able to divide fundamentals from technicals. And if you don't understand the differences, you should probably not be investing in stocks. Start with something easy, like real estate, even though the irony is probably at least half of you don't actually own real estate, but that's okay, because I think when you watch my channel, eventually you're going to get convinced to buy real estate. Not from me. It's not like I'm trying to earn a commission off you, but because I think that's actually going to help you substantially catapult your wealth. Unless, of course, you already have a net worth of over $1 million. So with that said, I think smart people realize that why did Tesla have this horrible price correction last year? Nothing to do with fundamentals, or maybe nominally. Biggest thing was the easiest trend ever to short, because Elon was selling like crazy thanks to Twitter, and there was no end in sight in terms of how many Tesla shares Elon was going to dump just to fund Twitter. This is the easiest short ever. From the technical point of view, once you start the short trend, guess what happens? The algos and the institutional hedge funds managing those algos, they come out, not even just the hedge funds, all the institutions, they come out and go, oh, easy short. Oh, okay, going into recession, what should we do? Oh, okay, yeah, let's go buy Costco and McDonald's, which are, like McDonald's is an abject joke as well to be investing in, but it's performed a lot better year over year than Tesla. Why? Because, the technicals say, let's go in a recession from growth to staples. And then eventually we'll go back. It's very simple, okay? It's so that way, when they answer the phone to their complaining customers about us going into a recession, the pension fund managers, the hedge fund managers, the institutions, the banks, the Morgan Stanleys, whatever, are able to go, don't worry, we're going into a recession. We have moved from growth to staples, because obviously, you still have to buy toothpaste in a recession, right? Oh, yeah, that makes sense. It's so dumb. It is so dumb in the short term, the kind of technical movements that you get in the stock market. The good news is, in the long term, the fundamentals tend to shine through. Much kind of like we just heard nearly 2 years later, after the April of 2021 fatal crash in Texas, where two dudes launched a Model S on a small roadway, hit a turn, took the turn too fast, car drives into a tree, bursts into flames. What happens after it bursts into flames? The dude in the front climbs to the back because the car catches fire in the front. Who knows what happened, if he was injured or whatever, couldn't get out. Both of them died, which is terrible. Turns out the guy was drunk while he was driving. And I don't mean like you had a beer like 8 hours ago. The guy tested twice the legal limit. That's deep. Okay, that's really drunk. I mean, look, this is not to at all justify, like, nobody should ever drink after having alcohol, right? But let's just be real. I would venture to say 80% of adult drivers who are not Mormons or who don't otherwise just not drink have probably had a beer or a glass of wine at a dinner somewhere and then have driven at some point thereafter, okay? But this was much more. It's twice the legal limit. You're talking about like probably 6 to 9 shots of alcohol for a dude, okay, to be twice the legal limit. I mean, you are plastered to be twice the legal limit. You probably couldn't even walk at all if you wanted to. Okay, maybe even not that extreme, but you're gonna have a hangover the next day. Let's put it this way. Anyway, the guy's drunk, drives into a tree, the thing bursts into flames, they die. The big media story that comes out around it is Tesla crashes into tree, bursts into flames. No one is in the driver's seat. Must have been the guy showing off autopilot, and because the guy showed off autopilot and autopilot failed, clearly these poor people died thanks to Elon Musk's autopilot. That was literally the news story 2 years ago. You had scumbags like the LA Times say, where are the regulators? Why are cars allowed to drive themselves with nobody in the passenger seat? Which I just said a lot of things, so let's unpackage that for a moment. I had an 1.5 hour long interview with the editorial board of the Los Angeles Times when I ran for governor. And guess what? All it was a 90-minute opportunity to find any opportunity to write a hit piece on me so they could prop Gavin Newsom up on the pedestal. There was zero abject interest in actually understanding the perspectives that I was sharing. Scumbags. Don't like that. It's rude and it's wrong. It's not what consumers and voters in California deserved. But that's the mainstream media for you. They got to keep stroking the guy in charge so that way they get invited to his press conferences. It's ridiculous. Okay, the LA Times allegation out of the way. Let's go back to what they wrote. So what did they wrote? Or what did the mainstream media write? Oh, where are the regulators? Where are the regulators? Tesla crashes into tree. People die in flames. Where are the regulators? Oh, wait. What comes out now? Oh, wow. No self-driving or any autopilot features were actually enabled. The car crashed without any automated or ADAS support systems activated. Finally, we find that out 2 years later, but that's after the story already broke. That's sad. But not only is that sad, you have no one, well, with the exception of some folks on Twitter doing God's work, so to speak. You have nobody, no mainstream media admitting the disgustingness of their headlines, suggesting that without any conclusion, oh, okay, well, because the guy was found in the back, it must have been autopilot. Even though that's not how autopilot works, like you have to somehow be able to engage the steering wheel to actually be able to function on autopilot. Mainstream media doesn't want to take the L for it because it's embarrassing. Anyway, here you go. NTSB reports in a report released Wednesday showed evidence indicated that the driver of the Tesla Model S hadn't engaged any of the ADAS features before crashing in Houston. In April of 2021, 2 cars' occupants died. Initially, a local constable said he believed the Model S had operated without anyone in the driver's seat when it crashed into a tree. But that was also very quickly dispelled because the fire department realized, wait a minute, the steering wheel is damaged, implying the person wasn't wearing a seatbelt. True, with the seatbelt. But anyway, the damage on the steering wheel implied that when the impact happened, the person probably hit their head on the steering wheel, which is pretty crappy. But anyway, here's just another sort of finally, after 2 years, finally, some relief and justification showing that Tesla, once again, was not at fault. But that doesn't make for a good media story. Anyway, now it's worth looking just briefly, since we've gotten over some of the anger around Tesla in the mainstream media. It's worth looking a little bit at the fundamentals because, yes, Tesla has officially broke $200. Now, one of the things that is fascinating is myself and the team just a few days ago when we were in the race for, to see if we could hit $200 before the expiration of the coupon code for the programs on Building Your Wealth, which we just hit $200. But anyway, we were talking about this belief that we have that once Tesla breaks $200, it would probably rip past $200. And in pre-market right now, it's sitting at 208. I think today will be the test to see, now that we have officially closed past 200 yesterday at 201.29, will we rip past 200? That is just a belief that we have as it's bounced basically straight up off of this Fibonacci curve. And so we'll keep an eye on it. In the past, Tesla used to have these like 27 to 30-ish day runs of the stock market being open. What does that put us at now? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. Hey, based on old school history, we should have at least another 5 days, which is interesting because you got CPI coming up next week. But anyway, let's look at some fundies for a moment. So going back to fundies, I haven't really changed anything here. I'm taking about a 10% take rate on FSD, which is extremely low, but I'm doing that on purpose on the 10% take rate on FSD for 15K because there is the monthly software as a service option where basically you can pay a monthly fee for FSD. And so I'm lowering the cash that goes into Tesla basically right out of the gate for 2025. My 2025 projection is 1 million vehicles fewer than what Cathie Wood is projecting, although she's got some pretty ambitious targets, let's just say. There's no shade on Cathie, okay? I love Cathie. I think she's a brilliant marketer. But I think some of the numbers are too ambitious, but that's okay. Maybe I'm just being a little bit more conservative, and that's okay. Everybody can have a different point of view. Revenue per vehicle, I'm at about 47,000. I think she's right around 46,000, so we're pretty close on that. But anyway, I put in about 10% from FSD. I don't put in any revenue for insurance, semis, Tesla bot, auto taxis, or self-driving taxis. I don't put anything in for that. I do put in about 10% for services, which mostly gets costed out because the margin's very low on services, although it's finally going positive. And for energy, I just put in basically 1% of total sales represented by about energy, which could end up being low. If I go with like a terribly low margin of 80%, which we should not be at a 20% gross profit margin in 2025, we should realistically be back at 25%. So we'll change that number in a moment. But if we leave it at 80%, you're looking at a future price target based on a PEG ratio of 1.67 at 30% assumed EPS growth. So if you think EPS is growing at 30% in 2025, 6, 7, 8, then you assign a 1.6 PEG, very, very traditional, very normal, you should be at least $400 in 2025. Now, if I change this margin to 75, so a 25% gross margin, you can see that quickly jumps to 511. So somewhere between 400 and 511 by 2025 seems very reasonable. One of the downsides, though, is that the present value has been skyrocketing. That is the ironic downside of the price going up, is that your rate of return now on Tesla from when I've been previously making these videos has dropped almost in half. It's dropped almost in half because the price is so much higher now. Now, don't get me wrong, it's still a phenomenal number. Even in the worser case scenario, I don't think that's a word. But even if at the $399 price target for 2025, you're looking at somewhere around a 24% compounded annual rate of return. Now, keep in mind, while I think what I'm talking about is financial and some people may see some of this as advice, I want to be very clear. I'm not giving you personal advice, okay? I think I provide great advice on the channel, but I'm not providing personalized advice. I am a financial advisor, but that's a very important difference is I'm not providing anyone. I don't do it. Personalized advice. I don't look at what heck is going on in your world and your portfolio and go, you should rebalance this to this. Okay, that should be obvious, okay? But anyway, some people don't recognize that that's obvious. So anyway, but I think this is still very, very good. This is with a worst case scenario number here, 24% year over year. But however, Tesla's going to get to the point where this is going to start looking less attractive, right? Let's say this gets to 350 this year, right? So say Tesla runs to 350 this year. All of a sudden, in your more worst case scenario, you're only looking at a 4% compounded annual rate of return. At that point, it makes sense to just dump everything and go all in on house hack. For me, not personalized financial advice. Just saying. Now, if I go with a different margin and I go a little bit, let me go more ambitious here, okay? Let me go 30% to see opportunity cost, FOMO-wise, what you would then potentially miss out on. Go back to a 30% gross margin. Potentially, now you could be at a future value of 623, right? And so your compounded annual rate of return would then be 21%. So my expectation would have to be greater than that for investing in something else, which I think could be reasonable. Especially since that is probably a little bit more hopium. Maybe you're closer to that 25% level, which is about a 13% annual compounded rate of return for about 3 years. So anyway, depending on how you play the numbers, should, in my opinion, guide your investing thesis and your plans for the company and for your investments. Obviously, I think that fundamentals are the most important thing when it comes to investing. Let me give you another brief example, okay? When it comes to growth rates, because this is very important. Some folks asked me yesterday, they're like, Kevin, Enphase had these great numbers. Why did it sell down? And I think people don't, objectively really look at the fundamentals. I think generally people on the internet look at the headlines. And then when they look at the headlines, they make a conclusion based on those and don't actually pull up the financials. So I was asked, and this is valuable for Tesla as well, okay? So I was asked yesterday, hey, what's going on with Enphase? So I tweeted this. You can just follow me totally for free at Real Meet Kevin over here, right? Why is Enphase plummeting after great earnings with a quadruple beat, top line, bottom line, margin, and guidance? That's a quad beat, okay? Simple. Well, I wrote, after hours trading is often low liquidity and undereducated trading. Headline reading, not fundamentals. That's because after hours, Enphase was up like 10%. But what did Enphase close at yesterday? Well, Enphase closed like down 4% yesterday. So why is after hours so different from when the market is actually open? Oh, wow. Surprise, surprise. Because you actually have people with, big boy money making decisions based often on fundamentals, but not always. Could be based on technicals, right? But anyway, here are the problems, what the fundies show. You have a company whose growth rate used to be 30% a quarter, 20% a quarter, 14% a quarter, and you ended with $724 million of revenue in the fourth quarter of 2022. The projected revenue is expected to be $720 for the first quarter. That's the midpoint. Could be higher, could be a little lower. Well, that represents a negative growth rate quarter over quarter. And we understand there's a massive seasonal difference between going from Q4 to Q1, but especially in the solar world. But at the same time, your costs are going up by somewhere around 1,500 basis points, and you're expecting a lower gross profit. So all of a sudden, you have a company that's growing like crazy, not growing like crazy anymore. And this is where if you go back to the Tesla fundies and you look over here and you go, well, if the growth rate it falls from 30% on earnings per share, and let's say that growth rate just, let's say it goes down to 10%, okay? Well, 10% times 1.67 means you should only be trading for about a 16.7 times PE ratio, which that brings your price that you're able to pay for the company to $170, which means you should sell it today, right? But nobody actually believes that Tesla's only going to grow at 10% on an earnings per share basis for the rest of the decade. That'd be crazy. If you believe that, do not invest in Tesla, right? So that's the point of having some form of stable PEG ratio, 1.67, which then you adjust based on EPS to find out what kind of multiple you should be using for the company. The reason you have companies like Ford and GM selling for these incredibly low multiples is because their growth is like nothing or negative, or because the CEO of Ford is a complete idiot. Well, maybe I shouldn't say he's a complete idiot. Well, let's just put it this way. I tweeted the other day, and again, another reason you should follow me at RealMeKevin on Twitter. It doesn't cost you anything to follow me over there. But I tweeted the other day this clip of a Ford CEO, Jim Farley, on the earnings call. And I was so blown away because he's bragging about how they're going to make lots of money going forward. That's what he was bragging about. How are we going to make lots of money going forward? in basically automotive. And he's asked by an analyst, hey, do you think you could get to a 20% gross margin, which is Tesla's worst case scenario, by the way, right? In other words, an analyst is going to Ford and going, yo, do you think you can make it to Tesla's worst case scenario? And the CEO has the following to say about getting to the worst case scenario. Basically, he starts off by saying, well, no, basically not on the car, because we're still figuring out the manufacturing process. Even though we've been manufacturing for over 100 years, we can't figure out how to make an electric vehicle profitable. And we probably won't be profitable on electric vehicles until 2026. But here is where we can make real money, okay? This was just embarrassing. Even the way he said it, okay? Ready for this? Listen to this.
Not our batteries, not the EV platforms, but our new fully updatable electric architecture. Because what we've learned on Pro is we can make real money on software.
Did you hear that? We can make real money on software. I mean, first of all, it sounds extremely creepy the way he said it. But it's because they're sucking. It's insane. And sure, Mr. Steve, look, you know what? I appreciate you, Mr. Steve. Mr. Steve here says, and look, we love Steve. He's a course member. Steve and I, we're going to have great beer together one day. When my plane is back to flying, because it's going under a warranty upgrade right now, we're going to do great stuff. Steve here says GM is securing the battery supplies needed. Tesla's lacking. That's fantastic. And so is Ford. Ford is also securing the supplies that they need to be able to make the vehicles that they need for the year. Ford said exactly the same thing. That does not make them profitable, though, on EVs. GM won't segment out their EVs and their EV profitability because they're not profitable. So you can secure the supply chains all you want. I'd support your argument in saying that EV supply chains are probably going to have more of an issue, right? But that doesn't mean you're actually going to be profitable. And this idea that Ford's manufacturing quality is better than Tesla, I mean, this is like an age-old argument. Tesla has panel gaps and stuff like that. Let's talk about Ford's manufacturing, though. But you know what? Rather than me make an argument about Ford's manufacturing potential and quality or whatever, let's just look at what Ford's CEO said about their quality here, okay? So let's see here. Okay, here we go. The real future profitability on EVs is basically what they call second cycle products. This basically means we suck at manufacturing EVs, and once we figure out what we're doing wrong, then we'll be able to finally be profitable, maybe. Keep in mind, and you can just Google this, nobody expects Ford to be profitable on EVs until 2026. That's 3 years from now, potentially 3.5 years from now if you look at the end of the year, or it'd be like 3.75. But anyway, we didn't know when we designed our first electric vehicles that we had basically wiring for our cars that was 1 mile or 1.6 kilometers longer than it needed to be. We didn't know that it's 75 pounds heavier than it needed to be. We didn't know that we underinvested in braking technology. Oh, that sounds fantastic. So look, I get it. Manufacturing is an iterative process, but you're taking an old dog and you're trying to teach him new tricks. Look, don't get me wrong. Some of the old school Fords were great. I wish I could find that anecdote. Maybe I could find it really quick. There was an anecdote yesterday, and I realize it's an anecdote, so it's not it's certainly not something that we could say is a fact right now. But let's look at Ford recalls. There was this dealer who yesterday on Twitter was complaining about Ford's quality. And again, I realize this is an anecdote, okay? I hate it when people do that in politics and they don't flag that it's an anecdote where they're like, oh, well, this is how it is because so-and-so says so. It's like, well, it's an anecdote, okay? It's an anecdote. But it's just something to pay attention to. So a car dealership guy, great guy. You should follow him. Oh, I don't know why I'm not following him. There we go. I followed him. But anyway, car dealership guy, great guy. Hey, he follows me. Anyway, so he writes, Ford dealer unhappy with Ford. In 2012, Ford had 1.1 million recalls. In 2022, Ford had 9.8 million recalls. Ford should only have one goal, to build the best quality car in the world. Word of mouth would sell it, not rebates and not advertising. In my entire career, the quality can't be any worse, and we are told it is now being addressed. Why wasn't it addressed 10 years ago? And he talks about the stat we just talked about, blah, blah, blah. I don't know. I don't know. Again, like, you know, I don't want to come across as cherry picking. I don't think the car dealership guy is like abjectly like, you know, only for Tesla. He writes some pretty neat things as well about like Carvana. He pays a lot of attention to what's going on with Carvana, car auctions and such. And we'll talk about this a little bit more later. So I think he's worth a follow. You know, I'm trying to get him to do an interview so we could get a face reveal, but he thinks that a face reveal would end up hurting his ability to have people actually want to follow him. So I don't know. I love the self-deprecating humor, but you know, anyway. So that is my thesis. My thesis on Tesla. No, Steve, I'm sorry. Okay, Steve's like, haha, I just got wrecked. No. I'm sorry, Steve. Okay. Like, again, it's an anecdote. Maybe that's not actually what's happening. I don't know, right? It's just something we want to pay attention to. And I guess the way I look at it is the frustration that I see by the CEO in the earnings call kind of reiterates a little bit of some of the issues that they have here, right? And this idea that you know, they don't even expect themselves to be profitable. I think in the long term, that's more important. I think ultimately companies will probably get to the bottom of their quality issues, but who knows? Maybe not. Anyway, that's my take on Tesla. Let's go ahead and listen to Bloomberg for a moment, see what's going on over here.
There we go. A sanctioned Dan
Third
Tannenbaum
N.
of Oliver Wyman.
3 N's. T-A-N-N.
Tannenbaum.
Wow.
There we go.
That's a lot.
I mean, it was worth asking.
You'll never find me.
Okay, these guys are boring. Come on, man. Like, say something. Let's go over to CNBC.
That seems like the same thing. They're not exactly the same QSIP because they're common shares, different classes. So we brought this to Goldman Sachs and said, hey, we're seeing hundreds of these types of trades because it's not just Shell. There was other companies that have 2 different classes. And they said, basically, whoops, we didn't mean to be doing that. I mean, this goes back 10 years. And so what they've told us is that they're notifying clients that we're unwinding these trades. We're not going to do these anymore. Steve Ballmer said he's going to amend his taxes.
But here's the more
Oh, that's fascinating. How the wealthy sidestep the wash sale ban. They just have different classes of shares. Oh, that's brilliant. Oh my God. Too late now. Cat's out of the bag. Anyway. Okay. So I think it's worth doing a little bit of talking about the Fed. We've got some talk to do about consumers, a CPI preview. Oh, good Lord. We also have to talk about, oh boy, we got a lot to cover. It's going to be good. We can talk about Nordstream. I tweeted about Nordstream yesterday and people got mad at me. Now people are happy because of something that happened yesterday. But anyway, let's briefly understand a little bit about what's going on with at least the latest in terms of Fed speak. And I'm also going to pull up the latest conditions. Actually, we could just go pop on over here. So, loosening again. Okay, interesting. All right, let's go. Let's talk about the Federal Reserve and what's going on with financial conditions. The reason we want to talk about financial conditions is very, very clearly important because Jerome Powell, in his discussion with Dave Rubin from the Washington, D.C. Economics Club, asked Jerome Powell, or Jerome Powell was asked, hey, Jerome, what do you think about this latest jobs report? And immediately Jerome Powell responded and said, financial conditions already tightened. Now, I thought that was really incredible because you immediately had this response from Jerome Powell that suggested, hey, look, we're just letting the market respond to the data right now, and we're going to respond to the data as it comes in. Now, that actually gives me a lot of confidence and faith because it shows the market understands the challenge we face. We must get inflation down. And when reports come in hot, guess what happens? Treasury yields rise. And that's exactly what happened. Although today, they're softening a little bit. Now, right after the FOMC meeting, we were down at 3.38. Now we're sitting at about 3.59. Yesterday, we were in about the 3.6 range. We're still a good chunk, about 20 to 30 basis points higher than where we were at the low just about a week or so ago. But it's worth taking a look at some of the analysis, some of the reports that we're seeing. So let's start with Goldman. Goldman here suggests the following, that macro data is trimming policy tails. And this argues that maybe rates could go lower or rates could go higher. And basically, they're suggesting here that they believe that ultimately monetary lags are going to be shorter than are commonly thought or traditionally thought. Now, that's actually a little bit bearish because it suggests that the Fed may potentially not be able to put too much weight on this idea that monetary policy is going to lag and we could just kind of get to a certain point and wait longer. They might end up being a little bit more aggressive if they need to. This is quite interesting because it's not the best and most bullish thing for markets to think, okay, if the Fed has to be more aggressive, then what do you end up with? Well, the following. The strengthening case for pricing a narrower path for the policy rate around the projected rate of 5 to 5.25%. And this, in their opinion, translates to higher, longer maturity yields. Basically, in English, yields could be higher for longer. And yesterday, we got a little bit of Fed speak that ultimately gives us a path for how long could the Federal Reserve end up needing to keep policy restrictive, especially if the lags that we think monetary policy have are not going to be as drawn out as maybe they had been in the past. In the past, we used to think that the Federal Reserve would raise rates and it would take about 18 months for those higher interest rates to actually trickle through the economy. Now the Federal Reserve says that lag could be as little as 3 to 6 months. It's pretty incredible, but that does mean the Federal Reserve has to be hawkish for longer. And the question from Goldman Sachs is, okay, well, have their recent discussions been hawkish? Well, according to Goldman, even though it seemed like Jerome Powell was dovish, the Goldman Sachs economists note that implications for the Fed path this year actually leaned a bit hawkish, particularly Powell's optimism on growth despite recent weakness in survey data, and that his observation was very clear, that doing too little was the most difficult risk to manage. Now, that's important because it aligns with some information that we got yesterday about how long does the Fed actually think they're going to keep rates high. Now, this is very important. We have believed, based on the bond market's expectations, that we would end up seeing the Federal Reserve cut rates by the end of the year. And if they cut rates by the end of the year, even though they say they're not going to cut rates by the end of the year, even though the bond market's pricing that in, it could happen if data continues to come in weak. However, yesterday, we had Mr. Williams from the Federal Reserve unfortunately deliver a little bit of a blow to us. Mr. Williams said that not only is it reasonable to get to 5.1%, but we're going to need to maintain, quote, I'll just read you the quote, we're going to need to maintain, quote, that rate for a few years to make sure we get to 2% inflation. That's terrible. That's very bad. It is exactly the opposite of what the market has been pricing in. The market's been pricing in that we're going to get to a peak, we'll stay there for a few months and cut down. Now, this is just one person at the Fed, and it doesn't necessarily mean that because one person at the Fed thinks we need to maintain a rate of 5.1% for years, that we are going to. But let's just say when this press conference happened, people were not very happy in the market. And guess who is a committee member on the Fed this year? Oh, Mr. Williams, the person who thinks rates should stay at 5.1% for years. That's not good. That's actually quite bad. And this is potentially because even though on one hand, Jerome Powell is talking about how disinflation could be at least inferred as being dovish by markets, Jerome Powell is making it clear that, look, even though we're seeing disinflation in goods, we need to make sure we actually see disinflation materialize in housing and core services, which so far we have not yet seen, although we think leading indicators suggest they will, but we still haven't actually seen that come through. That potentially creates the risk that inflation is stickier than expected. This is a little bit of a risk factor. So now we consider, okay, well, what are markets pricing in right now? And we can see exactly that. There are a few places we can go. We could look at, first of all, financial conditions. I'm a big fan of watching financial conditions. The easiest way, in my opinion, that you could track financial conditions is simply look at the 10-year Treasury. The 10-year Treasury is a very simple barometer. And anytime we see it loosen, we tend to see the Fed talk a little bit more aggressively. Anytime we see it soften or tighten, we tend to see the Fed talk a little bit more dovishly. So they seem to be very well driven by what's happening in the bond market, not necessarily what's happening in the stock market. Think about that. Jerome Powell doesn't talk about the stock market going up. He talks about financial conditions, which, yes, stocks are a part of, but they're a much smaller part of compared to, or part of financial conditions relative to the weight that interest rates have. Interest rates are huge because they affect everything. They affect people's credit cards, their buy now, pay later loans, the payment on the iPhone they want to borrow. If they're really stupid and want to buy a plane, they could do that. And I want to be very clear about that. I think for 99% of plane purchases, they're absolutely stupid. The only reason you could ever remotely suggest it makes sense to have a plane is if for some reason you think it's some crazy business investment that's actually going to be able to help you build $1 billion company because of the insane plans that you have for creating phenomenal growth and cash flow at a startup that you might be creating. But short of that 1% potential delusion or reality, we'll see what happens, knock on wood, no guarantees, nobody should buy a plane. I don't know why I went down that tangent. But anyway, let's look at Goldman Sachs financial conditions. Goldman Sachs financial conditions index. And we'll be able to see a little bit of what's going on with financial conditions. And then we'll also be able to look at what we think traders are pricing in for the rate increases with the Fed. So we're going to pull up on screen right now the Goldman Sachs Financial Conditions Index. You can see that here. You can see that financial conditions were actually substantially low on the left side of the chart. You can see that here in the left side of the chart. You end up seeing that this is when the Federal Reserve actually ended printing money, which is insane to think that in March of 2022, the Federal Reserve was still printing money. Absolutely insane. Insane. Okay. Since then, financial conditions have tightened substantially. They're very, very tight relative to where we have been over the last certainly few years here. And the jobs report was right here. And the jobs report popped up and re-tightened financial conditions. So I don't think you're in a situation where you could say that, oh, financial conditions are super loosey-goosey, like the days of quantitative easing. And the reason I'm saying that is because there's this bear who posts on Twitter and he's like, oh, financial conditions are super loose. I'm like, what are you smoking? It's way tighter than what it was at the beginning of last year. And this is when we had the giant inflation crisis. So this is something we want to pay attention to. Generally, we want to see that stay relatively tight, right? And so what are markets pricing in right now? Well, if we look at the Fed rate monitor for March, we are looking at a 90.8% chance of a 25 basis point hike. That would bring us to 4.75. For the month thereafter, we're sitting at a 69.8% chance of hiking another 25 basis points. That would bring us to about 5. And then in June, we're pricing in only a 28% chance of a hike to 5.25%. And instead, 15% chance that the Fed actually cuts rates 25 basis points. So, or that could be representative of a pause the prior. Probably unlikely to be a cut. And then a 53% chance that we stay stable. So markets are pretty well believing that we've still got a couple 25 BP hikes in front of us, but then we're looking at a pause. And after that pause, then it's just going to turn into the question of, okay, well, when does the Fed pivot? Which yesterday we discussed that the Fed pivoting is a sign that we are winning on inflation. And it is the best possible news ever. Unlike those charts, the people who don't like to think next level end up circulating saying, oh, when the Fed pivots, the market crashes more. I'm not going to go through it again. I explained it yesterday. The Fed pivot aligns with winning on inflation in this cycle. Whatever. All right. Now, another thing that we can do is we can understand, because tomorrow we have another catalyst coming out. tomorrow, the next catalyst that we have coming out is the University of Michigan sentiment report. And the U of M Michigan sentiment report will also give us inflation expectations. We actually expect them on the 1 year to rise to 4% versus the prior release of 3.9%. It's too high, right? We got to get that down. However, fortunately, long-term inflation expectations remain anchored at 2.9% as the expectation for tomorrow. Great. Fantastic. We also just had initial jobless claims beat a little bit, coming in at 196,000 versus 190. Fine. Now, what's another thing that we could do? Because there are two main sets of inflation expectations we want to pay attention to. Number one, University of Michigan. Number two, we look at the bond market. You can look at something known as the 5 or the 10-year break-even inflation rate. And this has been a slight bit problematic, okay? In fairness, this is a little bit of a warning. And it's a little problematic that, there's a chance the Fed's going to have to keep rates a little bit higher for longer. And it's not great. So, let me show you the chart because I don't like it when this happens, but it is what it is. And I'm not going to hide it from you because I'd rather tell you about it and we can address it. The 5-year break-even inflation rate has unfortunately popped up. You can see that the 5-year break-even inflation rate is sitting at 2.47%. I believe that in order for the Federal Reserve to pivot, this needs to get down to about 1.6%, which is around the levels of where it was in 2018 when the Federal Reserve flipped. Well, unfortunately, it's popped up. It's not good. We are at the highest levels that we've seen since about the end of November. Now, as long as we continue this downtrend, it's good. But we do not want to see this start breaking and making new highs over relative to the second half of last year. So we have to absolutely pay attention to this. Let's take a brief listen over here to see if there's any commentary coming from this guy over here. Hold on, from the Fed.
Industries, being in Pebble Beach and talking to a bunch of CEOs there, it really feels like most CEOs are a little concerned about the broader economy, but most of them feel pretty good about their own businesses. Is that what you heard too?
Absolutely. So noticeably, we saw that the expectations going forward have moved very positive. So when we asked them about the likely outlook over the next 6 months, the last time around, roughly 74% of them said, do they expect things to worsen over the next 6 months? In this survey, that number went down to only 48%. So I think it's fair to say the majority of them are feeling much better, and they think things will probably be gradually improving.
This is good. This is the former vice chair of the Federal Reserve, Mr. Ferguson here. However, it's one of the reasons you're starting to see some areas of inflation expectations rise. And this is the weird thing about the soft landing. Okay, the crazy thing about the potential for a soft landing is that in order to engineer the soft landing, I'll like picture this. Okay, imagine you're a plane. Okay, you're coming in for a landing. And don't get me wrong here, okay? I had like 2 weeks of thinking I was going to become a pilot, and then I quickly flip-flopped on that idea. So don't blame me if this explanation is not great. Let's say, as you're coming in for the soft landing, you get these crazy, wind shears that are pushing you all over the place. As you're trying to land this plane on the soft landing, what you're trying not to do is crash, right? So you don't want to get slammed into the ground. Getting slammed into the ground would be a recessionary force, right? Would be too much of an economic slowdown because you don't want to crash. You don't want to push the economy into a recession. But you also don't want to push up inflation too much because then you never come in for the landing. And then you have to stay aggressive for longer, and then things could get worse because you could run out of gas. Okay, running out of gas is like inflation expectations going up, and it's really bad because it shows you're not capable of landing it, right? You got to be able to stick it. So you don't want wind pulling you up, and you don't want wind crashing you into the ground. But it's a very windy day. So this landing isn't going to look like a smooth landing. Even though the goal is that the wheels touch softly on the ground, in my opinion, it's going to be very much like that, which is basically like a very aggressively drawn squiggly line. And even when we hit, it's going to be like one of those bumpy air landings. It's going to be like a Ryanair landing. Okay. You come in for the landing. You're like, oh God, Ryanair landing, brace for impact. and you're just going to go bouncing along the runway because, you know, you paid $49 for your flight. and you know, the time that you actually have a soft landing, everybody's like, did that just happen? And then everybody claps, right? So that I think is the goal. But I think in the interim, we're going to get data on both sides. It's going to look, oh my gosh, this is hot. This is good. Oh my gosh, this is bad. This is bad, right? And I think that's all part of the nature of trying to come in for a soft landing. I think the big risks that we have right now are that inflation expectations run away. And the Fed says, look, we're staying at 5.1% until 2024. And the market, I'm not sure, has priced in rates staying higher longer. However, the market's also been fearful about an earnings recession. So in a weird way, if the economy picks up and lightens up, then maybe you don't have as bad of an earnings recession. And the nominal earnings recession that has been priced in is actually even too much. And this is why you end up having what I've been calling the Nike swoosh stock market recovery. So as we're trying to stick that landing, you could actually still have this rapid decline in stock prices. That was 2022, which is sort of your crash that was 3 times as fast as the dot-com crash. And then you have that Nike swoosh slow sort of recovery. I think that's what we're seeing now. I definitely think there'll still be legs down, but I'm overall, the data that we're seeing, people are asking me, they're like, Kevin, but this is hot. Oh, but this is weak or whatever. So far, what I'm looking at is relatively consistent with what I would expect for a soft landing. I'm not like, as soon as everything points one direction, that's when you get concerned. And I'm not talking about the band either. I'm talking about in January 2020, every company is telling you we have massive inflationary issues and we're raising prices like crazy. The only earnings call so far that I've seen where people are talking about raising prices is Unilever. And they're like, yeah, we're going to have to raise prices like maybe one more time on some shampoos, but that's it. We're done. Like everybody else is like, we're not raising prices. And the companies that are like, yeah, we're raising prices, they're like, yeah, we like Pepsi. Well, we raised prices less than our costs increase, but we did have to raise a little bit. And yeah, we don't want to raise anymore. Like people are losing the ability to raise prices. Price elasticity is going away. Again, these things are consistent with the soft landing. So that's my thesis. You know, Kevin is the oxygen mask that pops down and gives you a slight bit of hope. Damn it, Steve. Oh man, that's a good one. All right, some of my latest thoughts on the Fed. Okay, now we need to talk about Tucker. Damn it, Tucker. All right, this one's actually pretty entertaining. Oh, and then Steve, don't worry, we're gonna be talking about Dell soon too. Maybe if I get to it. Oh damn. Okie dokie here. Let's see what we got here. Tucker. So yesterday I tweeted this, and people got mad at me for tweeting this. But then again, you know, people get mad at me every day. I think they're like 10 people in the world that just wake up every day and they're like, what has Kevin done wrong today? And it's like, what a sad life people must live to live like that. You know, I wish them help. Maybe they need to get some friends. Anyway, all right, let's see here. What do we got? Ooh, there it is. All right, so stand by. We are going to talk about this in a moment. Steve and Kevin, a love story in the making. Oh yeah. The market is pricing in rate cuts in 23 and a pause in May. Last night, like yeah. Plane pulls up at the last second, trying to set it down. Yeah, the plane tries to land, and the plane's a FedEx plane, and realizes there's a Southwest plane right below him. No, that's terrible. That's true. That's just happened, by the way. That's an FAA disaster, mind you. Complete disaster. Okay, it actually looks like it's probably going to take a moment before I can pull this up. Dang it! I wanted to pull this up sooner. Yeah. Maybe there's another way I could find it. We will find it. Okay, let's give a moment here to Jim Cramer. Let's listen in.
Sports. He thinks the NBA is very good. Look, overall, there's more accountability. That's what Peltz wanted. Obviously, modest dividend. The people were let go. That's a very big restructuring. Give me. I don't know. I thought it was terrific. I obviously hate it when anyone gets fired, but Joe, I think he's going to bring back the magic, so to speak. And I was thrilled with what he did. Just thrilled. It was fantastic.
What does, if you were running it, Jim, how would you see the future of the media conglomerate? What do you put your biggest bets on?
Well, I think that you have to be Disney Plus. I think that they ultimately could, if they don't even need to bundle at a certain point. I know that that the regular broadcast business is what did do better. I think that was a rare spike, frankly. But Disney Plus is a winner. I know that if I were Bob Iger, I'd be trying to figure out how do we get more theme parks, because the theme parks numbers were extraordinary. I mean, people are traveling. They all believe life's too short. They're going to Disney World. Bob has a very good hand here that was obscured by management that I think really couldn't shoot straight.
And you think that I mean, there are, you could split all these companies off. Cruise, I mean, they got so many, but you think that it works. You think that you got the theme park, so you have the animated movies, so you put the Avatar part of the theme park goes down there. So you think that it does make sense. Why ESPN? I guess, how do you figure that?
I just want to comment about Disney. Bob Iger is pulling an interesting move here, and I actually kind of like it. First of all, Disney Plus just had its first loss reported of 2.4 million subscribers. Now they're looking at licensing their content because they're seeing revenue decline. But I love it because guess what he's doing? Not only is he going and cleaning house and firing people who shouldn't be there, the extra people that they don't need. And I know that sounds terrible. That's why they call it cleaning house. But anyway, he's actually coming out with sequels to the profitable things like Frozen, Zootopia, Toy Story 5. Like, the guy's smart. The guy comes in and goes, look, if we ain't making money, stop spending money on it. Cut. And not only are we going to cut where we're not making money anymore, but guess what else we're going to do? We are going to invest where we actually do make money. It's brilliant. It's so, simply brilliant. I love it. I think it's fantastic. So, great job so far on Bob Iger and his initial transformation here that he's working on. I'm excited about it. I'm excited to see how it continues to move. So let's see here. Now we've got to talk while we wait for, I actually don't think I'm going to be able to get this in time. I have this clip of Tucker and really wanted to play it, but I might, I have an idea. Okay, I'll figure this out. I'll make it work. In the meantime, while I make that work, we are also going to talk about what's going on with the CPI projection. So I think that'll be quite interesting because CPI, or as we like to say, CP-lie, is something we all want to pay attention to because the next report comes up very soon, which is kind of crazy to think about that we're already almost on the next CPI report. It's on February 14th, which who decides to make that on Valentine's Day? That just seems like wrong. I don't know. Maybe it'll be a lovely report. I suppose. I guess we wait to find out what happens first, and then we'll pass judgment. Who knows? All right, let's get into those previews here. We got to talk about CPI inflation and the projections for what CPI is going to look like going forward. The next CPI report is on February 14th. And boy, oh boy, the numbers for the projected CPI are not good. And that's because some of the data that we're starting to get is coming in hot again, including what's going on in the car market. And boy, it is weird, but it actually sets us up for a dangerous middle ground. Now that sounds interesting. Like politically being in the middle is often deemed like neutral, right? This is not a neutral middle ground. This is a hell of a middle ground. And I'm going to reveal that middle ground to you. So first, let's hit the projections. And we got to talk about that hellish middle ground because that hellish middle ground is a big problem. It is not the middle ground that you think it is. All right, so what do we have first on projections? Well, first on projections, CPI month over month in the last report was negative 0.1%. What is the CPI projection for this month over month report? 0.5. 0.5. That's huge. 0.5 represents an annualized inflation rate of 6%. It is way too hot. Now, I don't know if the market's going to sell off right before the CPI print or what. but that CPI number is scary high on the month-over-month basis. If you strip out food and energy, because we know food costs and like eggs, for example, even though eggs have recently fallen around 50%, they're still way more expensive than they were a year ago, substantially. I mean, you're paying like $1 more, which from an egg point of view on a dozen eggs is like basically almost paying double for a dozen eggs. It's insane. But anyway, even if you strip out the more volatile food and energy component, you're still looking at 0.4% month over month projected. Now, that's slightly up from the 0.3% we had last month, but still, that's 4.8% annualized inflation. That's bad on the month-over-month read. Sure, the headline number goes from 6.5 to 6.2, but because that core number is staying strong, it kind of doesn't imply that we're going to get this rapid disinflation continuing the way we hope. Now, that creates some nervousness in the market. And what we want to do is try to understand why. Why is there this hole in CPI projections to where all of a sudden we think CPI will rise again? Well, one of the reasons has to do with a surprise in used vehicle prices last month, adding to, well, not only car buyer frustrations because prices are starting to go up again for used cars rather than down, but the magnitude was pretty large. Not only have used car prices now gone up for 2 months in a row, but between December and January, used car prices jumped month over month 2.5%. And I hate to say it, but you could do some very simple math here. If you do simple math and you take 2.5% and then you weight it, like an anchor, right? Like an anchor weight. You weight it by 4.5%. So 0.025 times 0.045, you're going to see that you could actually see the month over month inflation numbers move up 1.1 percentage points on the month over month basis. Or I should say 0.11 percentage points on a month-over-month basis, solely from used cars. Solely from one thing, used cars. And those prices are skyrocketing. I'm going to draw that out for you because I understand it's going to sound a little complicated when you start talking about all these small numbers. I'm usually used to talking about big numbers around here. And when we start talking about like micro things, it's a lot harder to grasp. And I understand. I think all the Meet Kevin watchers are a fan of big numbers too. But anyway, looking at small numbers, okay? The last month over month read was 0.1% on a month over month change. Well, used car prices alone, if we start at zero, used car prices alone are going to bump that zero by 0.11%. So in other words, solely because of one part of the CPI read, you're going to see the month-over-month CPI read go up by 0.1%, solely because of cars. Now, we expect the month-over-month core read, which does include those core prices or used car prices, to be 0.4%. 0.11 of that alone is used cars, which only makes up 4.5%. So that means 0.11 is coming, and you still have over 95% of the report to go. That's not great. The used car numbers are a problem. And not only are they an issue, but according to the car dealership guide, they're actually potentially getting worse. This isn't great. I've said before, I encourage you to follow this guy. I think he's great. Hopefully you'll follow me on Twitter as well at RealMeKevin. But anyway, he says this. I can't stress this enough. The pace at which used car prices are rising at dealer auctions right now is absolutely baffling. As of this morning, auction prices were much higher than January. Well, that's not good. I don't want to hear that. How do we get out of the cycle? Low supply leads to higher prices lead to lower sales forecasts, which lowers the production, and the cycle goes on. So he's a little bearish on the idea that used car prices could actually go back down. But the problem with this is, if car prices are still rising and the market is hotter than in previous years, and it's only re-accelerating, and the official numbers will come out in 2 or 3 weeks, and he's sort of given us this sort of like he runs a car dealership, right? That's why his name is Car Dealership Guy. Anyway, if his impression is that the numbers are getting worse, and so far the official numbers over the last 2 months have been worse, it's a problem. Now, it is potentially possible that we could look at this and say, look, that's the nature of a soft landing. You have some increase in demand. People are excited again that maybe we're not going to go through a hellish recession. So they're getting themselves a used car again. So you're getting volatility. That's one way. If you wanted to put on the bullish hat, you look at this and you call it volatility. If you were a bear, you look at this and go, disinflation? What disinflation? And so the truth is probably somewhere in the middle, but it's a problem. It's a problem that you have used car prices popping off and the expectations for the inflation read are not that fantastic. And you've got the break-even rate of inflation jumping to levels we haven't seen since November. So there's some red flags that suggest this next CPI report could be slightly painful. It also doesn't help that the CEO of Hertz, you know, the company that went bankrupt but had this massive amount of used car inventory that became extremely valuable, which ended up saving the company and helping bail them out and letting them reorganize. Well, anyway, they say that the company is seeing big jumps in the prices over the last 5 weeks, both at auction and at cars sold to retail in the used car markets. Used car retail sales were up 16% from a sales point of view over December and 5% from a year ago, though used cars are still about 15% less expensive than they were a year ago. So year over year, the numbers are good, but the month over month is concerning. And usually we look at month over month numbers. Now, the good news is, and now this could be biased, okay? I understand this. But there is a White House Council of Economic Advisors, and they decided to put together a new wage series tracking measure to only track wages that go into supercore prices. Supercore is what the Fed is paying attention to see, are we actually going to see disinflation here? This is where we talk about, you know, Chipotle seeing lower labor costs, many businesses seeing lower labor costs. Those are disinflationary indicators. And we know it takes a lot longer for housing to disinflate and for wage-based services to start deflating, right? We know that takes time. Well, look at what the Council of the White House Economic Council of Economic Advisors put together. They say that this chart right here is the hourly wages chart at a 3-month annualized change. And you can see it is very nicely falling. Now, don't get me wrong. We want to see people make more money, but we don't want people to be making 9-10% more money in hourly wages because that leads to an inflationary spiral, a wage price spiral, and then you have to get Paul Volcker. Fortunately, even though we have bad news in that used car data, it looks like we're getting good news in the wage data. Now, this brings up the question about the middle ground. Okay, this middle ground is an interesting thesis, and I want you to think about this because I think it's very important for your investing future. The middle ground. And keep in mind, like, I try my best to provide you value that you don't get anywhere else, or at least perspective. It doesn't mean I'm right about everything. It's just I try to give you perspective. So let's pretend we are driving down a road, okay, and we're going downhill, okay. Inflation is disinflating, right? And this disinflation is driven by goods disinflation. Well, the goods disinflation, according to Bloomberg, is expected to be over by June. Okay? So we hit a bottom in the basically goods disinflation dragging the markets down, right? Or dragging inflation down, I should say. Well, then we expect that at some point in the future, wage inflation and housing inflation is going to come down, right? But before those come down, you could be in this terrible middle ground. I'll go ahead and say July, August, September. Let's just call that the summer hell. And the reason it's the summer hell is because you don't actually start seeing housing or goods disinflation or housing or wage disinflation yet. You actually start seeing inflation popping off again. So now it's kind of like you're getting the speed bump in the road, and it's actually expected to come back down. You get this sort of temporary goods reinflation. Maybe it's driven by China. Maybe it's driven by Americans. I don't know. And it's not until the second half, like actually probably the last quarter of the year, that you end up getting past that hump. And now what actually drives down the market, or inflation, when I say market, I mean inflation. What drives down inflation is housing, which is your sort of level 2 of disinflation, goods being level 1, and then wages, wage disinflation being level 3. That kind of sucks because it means you still got another humpy dumpy to get through. On top of that, You got stuff happening like earthquakes in Turkey, which I understand people like, Evan, I understand you're sad about people losing their lives in Turkey. I know, I mentioned it like every live stream, and it's a pisser. I am so devastated by what's going on over there. Just children and families. Go hug your loved ones, okay? Anyway, what's happening with Turkey? Well, now there's suggestions that Turkish countries, including the United States, rely on imports of certain metals, and we could actually see steel disruptions due to damages of ports in the Turkish region. For example, while Turkish steel accounts for only about 4% of 2022 U.S. imports of steel, we import about 7% of our long steel products. These are like railroads or like railroad tracks or rebar, which we use in construction stuff. We import about almost twice as much, about 7% of our long products from Turkey. Turkey likes things long. And as a global long product exporter, they make up about 11% of the global market. And so there's an expectation that a lot of metals are going to be affected by these Turkish disruptions, and that could increase input costs, producer price costs, which potentially could flow through consumer prices. So all of these little shocks that we get, they make the road a lot bumpier. So far, unfortunately, it doesn't seem like there are these terrible catalysts that suggest, oh my gosh, is this going to be the black swan that destroys everything? But it's important. I mean, Goldman Sachs had a whole piece on it. The impact of Turkey earthquakes on global steel markets. Now, no notable damage to steel mills. However, we highlight likely supply chain disruptions, particularly given damage at various ports. Particular one, we talked about some of the percentages. And the point is, all of the issues that we face in our economy get complicated by the normal oopsie doopsies that happen in life, whether it's nature or just normal oopsie doopsies. And everything is just going to seem more frustrating in 2023 because everything that happens, like this car information or this Turkey metal information, what this ends up doing is creating uncertainty. It creates fear, it creates uncertainty, and it just makes it less clear as to whether or not we're actually on that path to a soft landing. So it's something to keep in mind. But those are the CPI projections. I will obviously be streaming the CPI report at 5:30 a.m. On February 14th. So mark your calendar for that, and I'll see you there. All right. Now we got to talk about the Nordstream. Oh, boy. That's going to be a fun one. So stand by for 1 second as I get ready to talk about the Nordstream pipeline. This is where you get, like, people tell you, oh, you're going to put the tinfoil hat on. And it's all right. That's fine. No, yeah, you can be angry. It's okay. All right. So stand by. All right. This will be quite interesting. 7 seconds. We've got to talk about the Nord Stream pipeline because, boy, about 4 months ago, people were going nuts over the Nord Stream pipeline getting blown up. In fact, 4 months ago, there were a lot of rumors that the United States was clearly behind the Nord Stream 2 pipeline explosion. And of course, a lot of folks just called that straight up Russian disinformation because the idea was that, oh, why would Russia blow up their own pipeline? They don't need to blow it up. They could just turn off the tap on one side. Why would they blow up this incredible infrastructure that they have to be able to export their natural gas to Europe? You know, at some point, we hope that the war ends and Russia would be able to go back and supply natural gas. Now, that was one argument. Why would Russia blow up their own pipeline? Of course, the more mainstream argument was that, well, Russia would blow it up because they know that Europe's already going to say, you know what, we're never going back to buying your natural gas. Whether or not the war is over or what, we're done with Russian gas and we're not going to use your Nord Stream pipeline anyway. That's another argument. That's sort of the argument that says, oh yeah, Russia did do it. And so you have these arguments on both sides. you also, both sides, you also have this argument that why would the United States bomb the Nord Stream pipeline? That is going to release an insane amount of methane into our atmosphere, and it's going to basically double the rate of global warming that we potentially experience within the span of 1 year, right? Because of the amount of methane that's released. And so a lot of folks are like, no, it had to have been Russia because the United States would never do such a thing. Now, I tweeted about this article who was put together by a Seymour Hersh. Now, Seymour Hersh used to work for the New York Times. He's also worked for the New York Post. And so he's been a journalist for a while. And we don't know with certainty that the information that he presents is absolutely accurate. But Seymour Hersh provides an example of what could have actually happened. He believes that what he describes is actually how the Nord Stream pipelines were taken down. Now, I tweeted about Seymour's article yesterday morning, and folks told me that I was pushing Russian disinformation, which who knows? Okay, maybe it is. I don't know. Maybe Seymour Hersh is paid off by the Russians. Later in the day, Tucker Carlson covered the article in light detail, not super detail. I'll play a part of what he says here in a moment. But his actual article is really fascinating. And whether it's true or not, I want you to know how they pulled it off, how they potentially used sonar technology to activate exactly their plan. And it's very fascinating. And I want you to hear about it. But first, we're going to listen to Tucker's take on part of it, because he's going to set the groundwork for us. Then I'm going to go a little bit deeper into it. So let's listen to Tucker's take on it, and then we'll go a little bit deeper on it. Here we go.
Check in $1 bills for the Hooters girls.
Hold on. We're still on San Francisco. Here we go. Now we're getting to the story.
So before the war in Ukraine even began, both Toria Nuland at the State Department, the number 2 at the State Department, and Joe Biden threatened to blow up the Nord Stream pipeline. Watch.
I want to be clear with you today. If Russia invades Ukraine, one way or another, Nord Stream 2 will not move forward.
If Russia invades, that means tanks or troops crossing the border of Ukraine again. Then there will be no longer a Nord Stream 2. We will bring an end to it.
How will you do that exactly, since the project and control of the project is within Germany's control?
We will, I promise you, we'll be able to do it.
Now, I'm just going to pause there for a moment and say, look, those two clips right there are these are the clips that Russia ended up sharing. Russia ended up sharing Joe Biden saying that and Russia saying, look, we didn't blow it up. Look at Joe Biden implying before we even invaded that he's going to basically end the Nord Stream pipeline. Now, what's crazy about this is potentially what ended up happening. Okay, so there's this guy, and we'll go back to the opinion here on the video, but there's this guy, Seymour Hersh, again. It was not the New York Post, it was the New Yorker. He wrote for decades for the New York Times and the New Yorker, and he published a bombshell on Substack. And he said that the U.S. was actually the country at hand who blew up the Russia-Germany pipeline as part of a covert operation under the guise of the Baltic Operations number 22 NATO exercise. Okay, that's his opinion. He says he relies on unnamed national security forces. Now, usually, because this is obviously being picked up more by the right, usually the right likes to say, oh, sure, unnamed sources. So it's kind of like both sides do it. But whatever. This guy alleges that the Pentagon has been planning to blow up the Nord Stream pipeline since December of 2021, and that the Navy originally proposed. So I went through the Substack piece, and so it gives you a little bit more detail than kind of what we got. And I actually think the detail is what's fascinating about the idea of how this can happen. So anyway, the author proposes that the Navy wanted to use a submarine to directly assault the pipelines. However, and there were also discussions about potentially just dropping bombs from planes that would not detonate on impact with the water, but it would then fall down to where the Nord Stream pipeline is, and then they could be remotely detonated on time. However, the CIA allegedly came out and suggested, hey, we need to be very covert with our operation here. We don't want anybody realizing that, the United States is behind the Nord Stream 2 pipeline blow up, because then we're going to get reamed from a climate point of view, because we're going to release all this methane. And even though it'll severely weaken Russia's ability to export gas in the future, and the reliance of Europe on Russia's natural gas will go away, because there will be no more pipeline, which means, hey, maybe now they have to rely more on the United States, right? Because our natural gas and oil industry has actually been booming, especially since fracking has become a lot more popular. So anyway, CIA is like, no, this needs to be covert. So instead, apparently and allegedly, the CIA works with Navy divers under significant pushback, but eventually the CIA suggests we need to find a way to blow up the pipelines using divers. And so apparently they work with the Norwegian army to find out where can we set explosives. And again, this is all alleged. We don't know if this is true. It's just an interesting story is the way I look at it. The Norwegian Navy apparently found a location only about 260 feet deep within diving range for the divers. And apparently they planted C4 on 4 pipelines. We know there were 3 explosions, and they were covered with concrete protective covers that could be triggered at some point in the future. So that way it wouldn't seem like, somebody was just there and then it blew up right after. It could be triggered at some point in the future. Now, how they potentially triggered the C4 charges on short notice was fantastic, in my opinion. Apparently, what they wanted to do was use a plane that would drop a buoy in the water, and the buoy would send a sonar signal, and the sonar signal would activate the C4 charges. But the problem is, in the ocean, you have a lot of animals that use sonar, and you don't want to accidentally detonate it when you're not ready to. So instead, they used a sequence of sonar signals, kind of like somebody playing a flute. How eerie is this? It's like the most eerie thing ever. How eerie is that? Think about that. Like, imagine you could hear the sonar, and it's like somebody's playing a flute, nice and peaceful, like you're on the Titanic. And as soon as the sequence completes, triggers the C4 on the pipelines, boom, blows the pipelines up. So the Norwegian Navy apparently had the sonar buoy dropped. And of course, the United States is denying this vehemently because they don't want to ever come across as potentially having created a climate disaster by blowing up these pipelines. But it's a very interesting story. Now, obviously, Tucker's got some pretty aggressive stances on this. He doesn't go into as much detail as I do on this topic. I think it's fascinating, but I want to give credit where credit is due. Credit is that 4 months ago, Tucker was the one shouting. Nobody else believed that it potentially could be possible that the United States was behind this. Got to give credit where credit's due. Now, we don't know if that's certainly the case, but let's just say the Nord Stream 2 pipeline went trending after this on Twitter, and a lot of folks are like, quite interesting, including Mr. Sachs, David Sachs on Twitter. I'd like to follow him. He follows me, which is kind of cool. But anyway, David Sachs. So what did he have to say? And I thought it was an interesting point, especially in the face of a lot of the geopolitical tensions that we face right now. He says, this week in foreign policy, errant balloon equals major provocation could incite war. Blown up pipeline, not a provocation, could never incite a war. And really what he's being sarcastic here. He's being facetious, suggesting that, look, everybody's so worried about this balloon. Meanwhile, here we are blowing up pipelines. Again, we'll probably never know with fact, 100% certainty what happened with the pipeline. But it's very interesting. And I have to say, after the last year of seeing so many conspiracy theories actually end up coming true through either the Twitter files or whatever, it just raises your eyebrows a little bit. It makes you go, it is kind of interesting. You know what else is interesting is China is making fun of us. I kid you not. China is now on the Chinese version of TikTok making memes about the Chinese balloon. And I'd like to show you one of them. This is a meme of that apparently was made in China to make fun of America chasing down the Chinese spy balloon. I'll play it without audio here because if I play with audio, I'll get demonetized. I think I've already said enough to upset the apple cart. But here you go. here goes the balloon. Oh no, the United States can't figure out how to shoot it down. Oh man, it does acrobatics. Oh, here comes a missile. Oh no. This is literally China just making fun of America at this point. And they've played this a few times now. And there have been a few versions of this circulating, including versions that show that basically put the Mission Impossible theme over this. It's pretty entertaining, and yeah. Anyway, there you go. Kind of shows that the way the balloon ended up actually dying was the balloon crashing into the fighter jet was the idea that the U.S. was so incapable of taking down the balloon. Now, obviously, we know that the U.S. actually shot down the balloon, and we don't have as much of an issue. But there are a lot of jokes going around and memes going around on this with for example, TikTok in particular. One of the things that I'm seeing on TikTok is people are turning the balloon into a Lego set. Now, I thought that was really interesting because here it is. I got it. Well, let me see if I can pause. Yeah, here it is. Look at this. How ridiculous is this? Commemorative Chinese spy balloon, age 6+, comes with a fake handshake and includes concerned citizen. And you can assemble this 176-piece Chinese spy balloon. It's ridiculous. Now, what's not ridiculous, and in fairness, is you do have the United Nations warning that we are creeping towards war, like world war, and it's bad. The United Nations chief has warned that he fears that further escalations in Ukraine will mean we are heading towards a worldwide war, and he thinks that the doomsday clock has been set to 90 seconds. That basically we're not even aware that we're basically sleepwalking into a wider war as we potentially increase tensions and aggressions between countries. That's not great. Anyway, that gives you an update on China and the Nord Stream pipeline. All right, so now let's go ahead and take a look at the sticks together, and then we will go ahead and head on over to the course member live stream for the market open. So usually in the course member live stream, by the way, we do a lot of fundamental analysis, whether it's on real estate. We'll also do technical analysis, whether it's on or fundies on real estate and stocks and that. We'll be talking a lot about companies in the course member live stream today, probably like a firm. And there are some warnings that come from a firm. We'll also go a little bit more on Enphase and some other companies we need to talk about. So love to have you in those course member live streams. Link down below to learn more about that, of course. But what do we have over here? So in pre-market right now, you've got Purple Mattress down 16%, Affirm down 15%, Mattel, toy manufacturer, warning that toy sales plummeted in November and October, only to slightly rebound in December. But Mattel, toy maker, down 11%. But then again, you had Hasbro come out with terrible insight as well on this sector here. You've got let's see, DraftKings down at $17. My goodness. You have some smaller SPACs here moving up a little bit. 23andMe up about 8%. I remember I got interviewed for a NASDAQ piece on 23andMe, and I was yapping about how overvalued the darn thing was. I'm glad I said that on record because the darn thing ended up falling. You can actually Google it. Look at that. February of 2011. VG Acquisition Corp SPAC deal with 23andMe is too, what was the title? Speculative? What did I say? Yeah, too speculative. And then they talk about me. Analyzing the SPAC deal with Kevin. Anyway, I just love looking at fundies of things. Robinhood had like a $57 million trading mistake, although they would have still lost around $130 million. Their loss is shrinking. They're spending a lot less on OpEx than they have in the past. Pretty impressive. Tesla right now in the pre-market up about 3.6%. And then I want to take a peek here as well at seeing what the 10-year Treasury is doing. 10-year Treasury right now sitting at falling a little bit actually at 3.58%. Curious to see how that moves throughout the day. That'll be fascinating. I've been on the waiting list for over 2 years for a family doctor. Went to the ER to look into something. Had to wait 8 hours to see a doctor for 2 minutes. It's bad. What they saw for 2 minutes was bad, or the wait was bad. I'm just messing with you. I hope you're okay. Hustle Smart comes in saying Tesla puts. Let's see here. Flat tax, push oil and gas, build pipelines, major funding for critical minerals. I don't think we're going to get a flat tax ever, but it's an idea that circulates a lot. No idea why TikTok hasn't been banned yet. Hey. You need to follow me on TikTok because I just posted a video on T-Swizzle. And the video actually got a ton of views really fast. I mean, people love T-Swizzle, man. You wake up the Swifties. Oh, man. Where is it? Oh, my God. It's at 1.3 million views already. That's crazy. I usually don't get that many views. But yeah, I had a little Swifty piece there. 1.3 million views in like 12 hours. Crazy. So anyway, follow me on TikTok at RealMeKevin. Also on Twitter at RealMeKevin. Kevin, been following you for a while. Was wondering your thoughts. I have 160K in a high yield savings account at 4%. My lease is up in April. Better to buy now or sign a lease for another year and wait to buy in early 2024? You know, these are usually the kinds of questions I answer regularly in the course member live stream, which I'm going to go to like in 10 seconds. Let me put it this way. I'll give you a freebie because I love you all for being here and I really appreciate you. I believe that one of the best things that you could do is look for a great deal. Get educated and try to get yourself a great wedge deal. If you could get a great wedge deal, you know, now or next month or in 3 months, maybe that's the perfect time to strike. So that's my thesis. So I would start your hunt, but don't buy something off the shelf right now, in my opinion. All right. Thank you so much for being here. We'll see you in the next one. Go to the course member live stream now. Goodbye.